The Fed just cut interest rates again, and it could change everything. After 11 straight hikes to fight inflation, they've suddenly reversed course, lowering rates by 50 points. Why now? What does this mean for you, your job, or your money? And more importantly, can the Fed stop the economy from crashing? Right now, the US economy is walking a tightrope. Inflation is cooling off after skyrocketing to over 7%, but unemployment is starting to creep up. The Federal Reserve is trying to avoid a full-blown recession while also keeping inflation under control. But here's the real question. Can the Fed pull this off, or are we heading for trouble?
The risk of higher inflation becoming entrenched has increased.
While unemployment is dropping, prices are up across the board.
This decision is more than just a headline. It's a make-or-break moment. After months of trying to cool the economy, the Fed is under pressure to keep things stable. But will this rate cut save the economy, or is it too late? Let's break down what's going on and why this could be the turning point that decides whether we see a soft landing or a rough crash. Why the Fed is cutting rates now? The big question is, why is the Fed cutting rates now? After months of holding rates steady, why make a move? It's all about timing. The Fed has been fighting inflation hard for over a year, raising interest rates 11 times in just 16 months to slow down spending and bring prices under control. At first, this strategy seemed to work. Inflation dropped from over 7% in 2022 to around 2.5% by mid-2023. But now, there's a new problem. The economy is slowing down and unemployment is starting to rise. While prices have eased, the Fed is worried about the ripple effect in other areas of the economy. Higher interest rates make borrowing more expensive, which can lead businesses to cut back on hiring and investment. That's why the Fed decided to cut rates, to ease some of the pressure and avoid a deeper economic slowdown. The rate cut isn't just about stimulating the economy. It's also about preventing things from getting worse. The Fed has to strike a delicate balance between keeping inflation in check and making sure the economy doesn't slide into a recession. By cutting rates, they're hoping to give businesses and consumers a little breathing room without overheating the economy again. But it's a gamble, and no one's sure if it will work as planned.
Nearly 70% of Americans disapprove of President Biden's handling of inflation, and he knows it's a challenge.
Labor market concerns and erosion of jobs. One of the Fed's biggest worries right now is the labor market. For a while, job growth was strong, but that's starting to change. In August 2023, the US added 142,000 jobs, a slight rebound from earlier in the summer, but a clear slowdown compared to last year. Businesses are saying they just don't need as many workers anymore, and that's a problem. The cooling job market is unmistakable, and once it starts to weaken, it's hard to stop. When companies stop hiring or start laying off workers, it can create a chain reaction. People lose their jobs, spend less, and businesses earn less, leading to even more job cuts. This is why the Fed is stepping in now with a rate cut. They're hoping to slow down the rise in unemployment before it gets out of control. If the labor market weakens too much, it could push the economy into a deeper recession. The Fed knows this and is trying to get ahead of the problem. But there's a risk here, too. If they cut rates too much or too fast, inflation could spike again, leaving the Fed to scramble to raise rates all over again. The global impact of the Fed's rate cut. When the Fed cuts interest rates, it's not just the US economy that feels it. Because the US dollar is so important worldwide, these changes have a global impact. The US dollar is used in many international trades and is seen as the world's reserve currency, which means when the Fed makes a move, other countries react. Central banks around the world often adjust their policies to stay in line with the Fed, even if they don't always admit it. One of the big ways this happens is through currency values. When the Fed cuts rates, the dollar can lose value. A weaker dollar means American goods are cheaper for other countries to buy, which is good for exports. But it also means countries that rely on the US dollar, especially some emerging markets, can struggle. These countries might face rising costs for imports or debt, making it harder for them to manage their own economies. The Fed's decisions also affect global investments. Investors might start moving money from one country to another, chasing better returns based on what they think the Fed will do next. This can cause sudden changes in stock markets and currency values worldwide. So, while the Fed is focused on the US, its rate cuts are felt far beyond American borders. The debate inside the Fed: slow versus fast cuts. Inside the Federal Reserve, there's a debate happening about how fast they should cut interest rates. One side, led by people like Fed Governor Mickey Bowman, believes the Fed should move slowly. They worry that if the Fed cuts rates too quickly, inflation could come back, which would force them to raise rates again later. Their main focus is making sure inflation stays under control for the long term. But others, like Fed Governor Adriana Kugler and Chicago Fed President Austin Goolsbee, think the Fed needs to cut rates faster. They're concerned that if the Fed waits too long, the job market could weaken even more, leading to higher unemployment and a possible recession. They argue that cutting rates quickly now might prevent a bigger problem down the road. This debate has been going on for months, and both sides have valid points. What they decide to do next could have a big impact on whether the economy keeps growing or starts to slide into a recession. How the rate cut affects you: mortgages, loans, and borrowing. Now, you're probably wondering how all this affects you personally. The Fed's rate cut can actually make borrowing cheaper. When the Fed lowers rates, banks often lower the interest rates on things like mortgages, car loans, and credit cards. So, if you're looking to buy a house or refinance your mortgage, you might see lower rates, which can save you money over time. The same goes for other types of loans. Car loans and personal loans might also come with lower interest rates, making it cheaper to borrow money. And if you carry a balance on your credit card, lower rates could mean paying less interest on your debt each month. But it's important to remember that while these rate cuts can help borrowers, they don't always show up immediately. It takes time for the changes to work their way through the system. And, of course, if inflation spikes again, the Fed could raise rates, making borrowing more expensive once again.
Everything that we need: coffee cups, coffee, sugar, milk, everything is a lot more expensive.
The Fed swap lines and global stability. Another key tool the Fed uses to help keep the global economy stable is something called swap lines. These are agreements between central banks that allow them to exchange currencies. When the Fed cuts rates, it can affect the value of the dollar, which can cause problems for other countries. The Fed swap lines help by giving foreign central banks access to US dollars during times of crisis. This is important because many countries need US dollars to pay their debts or buy goods from other countries. If the dollar suddenly becomes harder to get, it can cause economic trouble around the world. Swap lines are like a backup plan to make sure countries can still get the dollars they need, keeping the global financial system steady. Risks of cutting too fast. While cutting rates can help the economy in the short term, it comes with risks, especially if the Fed moves too fast. One of the biggest risks is inflation. When interest rates are too low, it can lead to an increase in spending and borrowing, which might sound great at first. But if too much money is flowing through the economy, prices can start rising faster than usual. This is what the Fed fears most: runaway inflation. If prices rise too quickly, it makes everything more expensive, from groceries to gas. The Fed would then be forced to raise rates again to slow things down, which could hurt businesses and consumers. It's a delicate balance between stimulating the economy and avoiding another inflation spike. Conclusion. In conclusion, the Fed's rate cuts have ripple effects that touch almost every part of the global economy. from your mortgage to how much your groceries cost, and even the stability of other countries' economies. It's a high-stakes game with big risks and rewards, and the decisions they make will impact all of us. Before you go, if you want more easy-to-understand breakdowns of business and tech trends, hit the like button and subscribe. You don't want to miss the next video where we'll dig into even more interesting topics. Thanks for watching, and see you next time.